Hey YouTube, it's Dimitri, and today I wanted to talk a little bit about Polymarkets, securitizations, tokenizations, and more specifically the ethics and morals behind all of this and what's going on, and just a little bit of a perspective, an opinion from my side, actually seeking your guys' opinions as well, seeing how these things come together. So let's just start off here with prediction markets. So for anyone who's not familiar with this, and I've been kind of following this on the edges, I just got back from a big quant kind of financy conference, and people are talking about the markets and Kalshi and Polymarkets, which are some of these exchanges where you do this sort of betting on here. And the question being is, this kept coming up, and people kept saying in the finance community, this is an amazing opportunity. It's a great way to hedge something very specific. There was a case made, instead of me hedging like an entire corporation, you could hedge a very specific event that will impact that corporation. And that's why it's an amazing tool and everything else. And I was listening to traders on the trading side of this, like, oh, we're really excited. We're getting in here. We're going to be making a lot of money. And then we heard other people talking about, oh, this is like market making. And if we can get our hands involved in this, we can help kind of structure like the microstructure. And we can look at this as an exchange. And as I was sitting here listening to all this, I'm like, but what's the value add from a theoretical finance construct? Right? A risk management, traditional finance, value added. Perhaps I feel like in many cases, I've been feeling like I'm the Warren Buffett of the quant community here. It's just going back to the foundational basics. And as these discussions were going, it's like I wanted to dive in and say, like, do you understand though, like what investing is? This is not investing because there's no asset underneath of this. Right? You're not investing in a corporation. And then I'm like, this would be too much to explain in a panel discussion, so I didn't say anything. But I'll put a video link above, perhaps in the description maybe, on like what is a stock and an equity, and trying to go back on like what is an investment. So you put this money into this investment basically into an idea, people build out a business, it creates a product or a service, and value is added to society. Okay, with Polymarket, with Kalshi, with these prediction markets in general, there's nothing underlying these. I think this is my fundamental issue with this. I'd love to see what other people say. I don't buy the hedging idea. I don't see how this is a hedge, right? You are saying, oh, I bet on something. Like pull up the screen here I'm looking at. Largest company by the end of March, NVIDIA or Alphabet. Okay, you could easily buy either company. You could long one and short the other and have the same prediction here. So I don't see a case for this. Again, S&P up or down on March 24th, you could still buy these assets when you're looking at these financial things. Will silver hit by the end of March? Different sorts of values here. Again, I don't get it. You could easily buy all these things and do the process in an actual asset fashion here. So you could argue perhaps this is like a hedge, like a derivative, right? There's real no asset here, but a derivative is based off of an asset, and you should hypothetically be taking the proceeds for that to do something at the end of it. If not, you're gonna have to be rolling this hedge along. And I can kind of see what you're trying to say here, but like, why not just go to Vegas and take your money and gamble? You could still get money, and if you win, you have money to hedge some unrelated bet. Like, you could argue, okay, well, Dimitri, some of these are specifically related, but then I'm like, why would you just not take the actual positions themselves? And I think one of the other cruxes of my argument here is, like, who's on the other side of these bets? Like, you could argue, okay, a big financial institution wants to take, a bet. Let's take, the gold one here. Will gold hit, 4,300 by the end of March? Will it hit 4,000 by the end of March? That's not a very specific spot, though. Like, what if I'm trying to hedge a very specific amount? Like, $4,235 is going to be the position I need, right? It makes more sense in my eyes to buy the actual asset and to do the hedge itself. And on the flip side, who's on the counterparty? These aren't just big financial institutions making these gambles. I think the issue that comes down here with ethics and morals, and ethics being, kind of a structure of what is right and wrong on a group or society or industry level, whereas morals are going to be, what is right and wrong on an individual level here, oversimplifying, of course. But like, where do we see this actually sitting, and who's going to be on the other side of that? And why I'm getting at that is because often it's going to be the retail individual. And people say, oh, like, we should allow everybody to get involved. But what a lot of you don't realize also as well in this quant finance industry is people are going to be spending a lot of money mining and taking these positions, are going to have an extremely unfair advantage trying to move and manipulate markets. And then it looks like you have a bunch of big financial institutions gambling and betting against the public. And if the public loses, why are people okay with big, smart, intellectual firms taking money from the public who's just uneducated on a lot of these sorts of topics and bets, right? And I say that because a lot of the public is going to be motivated through gambling and excitement of like, oh, I could make an extra $50, I can make an extra few $1,000s. And as I'm talking to everybody, I think there's a big disconnect between America, like the actual average American that's working a real job and trying to make ends meet and doing all that process. And yes, I've had a real job where, I had to do manual labor and construction. I worked in traditional business for some time too, doing accounting and finance and all that. But there are a lot of people in here that should not be gambling. And so you start to now look back, let's get back to the securitization of this, is this ethical, is this moral, and should we be allowing these sorts of markets to continue? I think that's what I'm trying to get at here from a moral and ethical stance. Can you use them for hedging? Sure. Are they the best tool for hedging? I don't know. I think that's what I would like to see you guys put in the comments below. Like, do you think this is really just betting and gambling? If it is, I don't really see any value in it. Now, you could try to spin it and position it into some other sort of, option here, some sort of, idea of how it's going to be beneficial. And to be honest with you guys, I think everybody's diving in so quickly. Everyone's trying to get an edge in this. Also, the only way to stop this, if it is ever going to be stopped, is going to be, unfortunately, regulations from the government. Because no hedge fund's going to say, yes, I think I have an ethic, moral obligation to not get involved in this. I think everyone's going to be diving in, and it's going to be a race towards the bottom. I would hope many firms and institutions think about their investors as well. Like, this might not be the best look, especially if these things blow up or they get banned, or even just from like a personal morals perspective of like, should I just be gambling with people's money? Like, yeah, I'm getting paid to do investments, but this isn't really an investment. This is a gamble here. So let me shift over a little bit to tokenization, securitizations here, and hedge funds in general, because I think this is tying into this as a different kind of prospect. And that's going to be like, we have laws in place that prevent people with assets under specific dollar values from investing in hedge funds, for example. And this is a historical law that's been put in place. I think this is going to be the same sort of thing with like securitizations. Like, why can't I go out and publicly securitize and sell asset-backed securities, whether it's mortgages or auto or something else, to the general public? These seem far more logical because there's an actual hard asset underneath of that, right? And if you're not familiar with securitizations, there are companies that manage and maintain and do like repossession. So imagine you have auto loans, which I've securitized in the past. You go out, you collect a bunch of these risky loans, and then you end up securitizing them into essentially a new asset. But as consumers default, there's an ordering in the securitization of who takes losses first, second, third. But also there's someone that's a servicer that goes and says, hey, customer defaulted. We're going to go repossess that asset. We're not going to be made whole, meaning I don't get 100% of my money back plus the interest, but I might get 60, 70, 50% back, something like that, to kind of help cover that. I think we should start looking at this from a let's be equal across the field, right? If you're going to allow people to be doing gambling, we should allow them to invest in, I think, hedge funds without some sort of financial restriction. I also think we should allow people to invest like mortgage-backed securities and more complex sorts of assets. I think we should completely throw out the window then as well any sort of restrictions on sophisticated investors getting into derivative investing. We should just open the floodgates completely and let all hell break loose. I mean, that's really what I think is going to be the crux of this issue here. Now, going back to this on the original laws, why did we create these original laws? And the issue is people viewed derivatives as gambling for the public, and that's what the public was using it for. Now we have literally a gambling site, a couple of gambling sites, for gambling as a whole. And you start to think, and I had somebody make this point on Wall Street, like, who cares, right? Everybody can make their own decisions. Dimitri, you said you're a libertarian, you like freedom, you like economics. This is the most optimal way to let winners win and losers lose. That's true, except for you have to add in one critical piece, which often gets left out of the conversation, which is going to be externalities. So in economics, an externality is when you do something yourself and it has a negative impact on somebody else. So an example of this is like, let's say I decide I have a bunch of chemicals from manufacturing and I don't need them anymore and I need to get rid of all this waste. What do? Just dump it into a river, right? Solves my problem. I get rid of my waste. My consequences are I get rid of the waste, and yeah, it might pollute my property a little bit, but who really cares? The externality of that, though, is going to be the fact that people downstream that are using that water are now going to get poisoned and have contaminated water because of my decision making. We're only thinking of me or my company in itself. This is really like you think about 2007, 2008. Similar sort of position. Everyone's leveraging up. Like these big banks are leveraging up to the point, if they go bankrupt in a banking stance, you're going to lose all that money in that position here. I don't fully know. I don't think anyone can fully comprehend the externalities that would be from some of the different sort of things we're talking about. Prediction markets, securitizations, hedge funds. If the market starts to tumble and tank, and a lot of these things are correlated because that's what finance is, a serial correlation here. And everything starts to tank together and everyone's losing money. And a lot of these individuals and people in average public don't have the funds to live. Then what's going to end up happening is, companies will downsize, they'll lay people off. They lost money in their investments and their decisions and all this process. And you start to kind of see this tumbling effect like we did in 2007, 2008, where it's like you weren't gambling. You were just an average American and magically jobs are disappearing, companies are going under, the government has to step in and bail out all these companies, which people think, so who cares? Well, taxpayer dollars is your dollar. You weren't involved in that. You're having to bail these sorts of people out here. And then the whole concept of too big to fail comes into this here. So I think these are things we need to think about on a moral and ethical stance. And to wrap this video up here as well, I'd like to talk a little bit about social media data. So this is what I was debating on a panel. And of course, everyone kind of waved their hands and said, Dimitri, we could debate ethics and stuff on social media, but I don't really want to do that. Let me talk more about, my firm and my company and why alternative data is great. Let's just throw all caution to the wind, which seems to be a common attitude, I think, on Wall Street. I think there needs to be a bit more regulation requirement. I do wish the Trump administration would actually take an interest in this. I know there are a million other issues going on right now, but when we're looking at the economy, I think regulations actually need to be ratcheted up. We are definitely towards the bottom point of this. And that goes into the social media point. And that was what I was trying to make the point of, if you look at alternative data, right, in the olden days, it used to be like satellite imaging. You'd look at a warehouse and you'd say how many semi-trucks are leaving, like Walmart, for example, the distribution center. And you'd say, okay, X amount are leaving. That's more than normal. Profits will be higher. But then you start to dig deeper. Like, if I could know what is in that truck, is that high-priced, high-profit technology like TVs, computers, that sort of thing? Or is it low profit margins like food, for example, right? This would help us dial in. So you'd say, okay, what's inside the truck? More importantly, if we could dive even deeper and say, what is everybody purchasing? Like, I could go back through and pull up a bunch of bank statements and credit card transactions and say, okay, how many people have shopped at Walmart? Where are these people located? Exactly, how much money are they spending as a whole? We can use that as a proxy. Going further down the rabbit hole, if I could look at every single thing you purchased on your receipt, for every sort of person, that gets even better and more accurate, and we could really get into this, right? But this starts getting into social media. If I know all of your behaviors, if I know everything that you like, you comment, you transaction, I can start to figure out, for example, how big your family is, if you're married, if you're single. We can estimate about how much money you make. Looking at your friend connections, should we be making decisions on investments, which is a little bit broader? People tend not to care about corporations as much. So you say, well, who really cares? It's just trading corporations. But then there's a privacy piece on the individual level, and then you start to get into actual banking, which actually is engineering a lot of these products from the ground up. Start thinking about this from a loans perspective. Imagine you go and you apply for a loan. There are currently laws in place which are good, and I think we have historically agreed with, marital status, race, ethnicity, all those should not be incorporated into loan decision making because they're not financial attributes of yourself. Now comes in social media data. If you can mine data on individuals, on their Instagram, their Twitter, TikTok, behavioral patterns, YouTube, all these different sorts of social media platforms, should you be able to use that in your decision making for loans and loan processing? Okay. Now, someone actually argued with me and said, well, Dimitri, it'd be much more efficient. All these banks are doing is using FICO. And so therefore we can use advanced data, alternative data, and machine learning, and we can make this far more accurate. And that would be better because that would be more accurate. And as I had to turn and go, do you really think banks are pulling out a FICO sheet? They've got this FICO sheet. They go, oh, Dimitri's at an 800. We'll make him a loan. So-and-so's at a 655. We're probably not. No, there are data. I have over 3,000 variables of data that we use to actually do model development for loan pricing that goes into this from looking at behaviors and all financial behaviors. Financial behaviors. We're not looking at alternative sources of social media and scraping and trying to do things which I feel like is a really mucky, unethical spot to be in. And I think this is why the regulations actually need to get ratcheted up on the investing side, because even the banks, I feel like, are starting to slip. The regulations are starting to slide. I think we need to start as a society have this bigger discussion. That's why I'm really making this video here. I want the discussion points to be had in the comments on LinkedIn, on YouTube, at conferences. Like, what are the ethical rules that we should set as an industry, as a society around data, alternative data, modeling, gambling, predictions, and all these sorts of things in the finance realm? I don't see a lot of people talking about this. And it's really sad because what's going to happen, it's all going to fail. And we're all going to start pointing fingers about like, who was at fault? You know, was it the prediction markets? Was it the government? Was it the banks, investment institutions? Like, who's responsible for this? At the end of the day, nothing ever really comes out of these. So 2007, 2008 was a great example. Everybody pointed the finger. We kind of went through the motions. Some bailouts happened. The public was unhappy. Wall Street has a bad name. Wall Street doesn't care. They're making a bunch of money. And we continue and rinse and repeat and do this cycle over and over here. So I'd love to hear what you guys think in the comments. Again, please be respectful. That's all I ask for you guys in comments, whether LinkedIn or YouTube, whatever. Like, these things just need to be discussed. Like, what are some interesting points? Like, you know, can these really be used for hedged and prediction markets? Should we just be using any sort of data that we can get to? Tech seems to be kind of on that motion of like just using whatever's available. Where should we put rules and regulations? Should we continue on the securitization rules and laws around like hedge funds and securitizations? Should we open this a bit more to the public? So blockchain technology could be used in this case to mass scale, like for example, securitizations, which would be really interesting to see. I would like to get personal exposure to a few different sorts of asset classes within securitizations, like mortgage-backed securities. What do you guys think? Where should we draw the line? What are some use cases for prediction markets that we should keep them around? Are there reasons we should just get rid of them? Is it really just gambling on itself? How should we kind of structure these laws and rules and keep a cohesive framework here? Because I don't see a lot of Wall Street talking about this. It's more like, I can make money. Let's run with that. There's not really a discussion of how this impacts externalities of society, how this is a bigger picture and a bigger societal problem, not just like a you problem. So anyways, I'd love to hear your thoughts and comments. Don't forget to like, share, and subscribe. And as always, until next time.